A very good evening, everyone. My name is Theseira, and it is my great pleasure to welcome you to Pricing a Negative Externality, Carbon Pricing in Malaysia. I'd like to extend a special welcome to all our participants from the entire ASEAN region. As you know, this is the third in a series of 4 webinars that's being held by CGM, and I'd like to thank our collaboration partners, the EU Roundtable for Climate Change and Sustainable Transition, ERCST, the World Bank, as well as ISIS Malaysia. So in this third segment, we'll be covering net zero targets and voluntary carbon markets, and this is a natural progression following the first session that we had, primer on carbon pricing, followed by the second mandatory carbon markets. And we've been very privileged to have with us a very expert series of panelists, a remarkable series of panelists so far. This evening is no exception. We have 2 very outstanding panelists, Mr. Björn Fonden, followed by Mr. Andrew Howard. So just a few housekeeping rules. Do keep yourself muted unless you would like to say something, ask a question. What we'll do is we'll go through both presentations and then we'll have the Q&A after. If you're afraid that you'll forget your question, what you can do is you can always write your question in the Q&A. There's a little Q&A button at the bottom of your screen. Click on that and you can type your question there. Also, you can read the questions that others have posed, and if you are particularly identify with any question, you can upvote it so that we can move it higher on the priority list. All right, so with all of that out of the way, once again, a very warm welcome to you, everyone. And let's move straight away to our very first panelist. I will not give their full biodata. You can read that on CGM's website. But I will say that Björn Fonden is the International Policy Advisor at the International Emissions Trading Association, IETA. So with that, I'd like to give Björn the floor. Björn, you can share your slides and begin your presentation. Thank you.
Thank you very much. I hope you can see my screen.
We still see the, yes, now we see the slide in presentation. Great, go ahead.
Okay, excellent. So thank you very much. Pleasure to be here. As mentioned, my name is Björn Fonden. I'm an international policy advisor with IETA, the International Emissions Trading Association. And I'm delighted to join you today here from our new Asia Pacific office here in Singapore. Now, before moving into the substantial issue of voluntary carbon markets, I think we need to recognize that we are really in a very dire and urgent situation. And these last few weeks, we have seen temperature record after record, with the hottest day ever measured, the hottest week on record, and extreme weather events across the globe in the Americas, in Europe, Africa, India, and China, impacting tens of millions of people. And highlighting the urgency we are in to also rapidly scale up mitigation efforts and to reduce emissions. Now, current targets from both companies and countries alike are unfortunately way off track to get us on a 1.5-degree Paris-aligned pathway, with the UNEP emissions gap highlighting a gap of around 20 billion tons of CO2 by 2030 in current conditional NDC scenarios. And of course, a vast share of that is actually here in Asia, with the region playing an absolutely crucial role in the global decarbonization pathways and to bridge this gap. The Executive Director, Inger Andersen of UNEP, highlighted that we need an increase of at least 590% in annual climate finance flows, including both public, private, and international sources. And so that is where I see the voluntary carbon markets can come in to help facilitate at least a portion of that finance needed towards the decarbonization efforts. And if we look a bit longer term at the net zero targets, around 45% of nations have already set clear net zero targets. 30% has proposed targets, but 24% are still without. However, importantly, this still accounts for 88% of global emissions covered by net zero targets. And in terms of companies, around 50%, so half of the world's 2,000 largest publicly listed companies have set corporate net zero commitments, but around 50% are still without. Now, many of these countries and companies will not be able to reach net zero by mid-century through their own operations, as they have limitations in resources, land mass, technology in hard-to-abate sectors, etc., leaving them with a small proportion of residual emissions, which they should be encouraged to cover by financing high-quality, high-integrity mitigation projects that can generate carbon credits. And that is also where we as IETA come in. So as IETA, we are the trusted business voice on market-based climate solutions. We are a non-profit industry association founded in 1999 with over 300 business members from across the globe, representing the entire market landscape with various sectors. And our goal is to empower the private sector to engage in climate action by supporting the establishment of effective market-based trading systems for greenhouse gas emissions and removals that are environmentally robust, fair, open, and efficient. Because we know that carbon markets can generate significant benefits. As an example, we have been conducting numerous research studies with the University of Maryland, mainly focused on Article 6, which shows how international carbon markets could save up to $250 billion a year by 2030 through utilizing the least costly abatement opportunities. And if we reinvest those cost savings into additional mitigation, we could double existing NDC ambition without any extra cost. So there is really a great opportunity to exploit here. And we also see a growing share of the world covered by mandatory carbon pricing instruments, as was mentioned previously, both carbon taxes and cap-and-trade domestic compliance schemes. In comparison to compliance markets, the voluntary market is still very small, even though it has been growing in the last decade or so. And I think Andrew might also speak more about this, but it still represents only a few % of the market value compared to compliance markets, which is mainly driven, as we can see also on the map, by the EU ETS, but increasingly also by other countries, including here in the Asia-Pacific region, like China, Korea, New Zealand, Indonesia, also emerging, Japan, India, Vietnam, Thailand, and hybrid approaches such as Singapore's carbon tax, which will allow for a certain share for international offsets. And I believe also we'll see a lot of movement on this in the coming years. And if you quickly look back on the history on the voluntary market, the demand we can see has been increasing rapidly, especially in these last few years, which channel much needed finance to decarbonization efforts. And as we move even closer towards net zero by mid-century, will grow further. And these are some of the projections being made by, for example, McKinsey and Bloomberg. Now, this growth has, of course, also brought on increasing scrutiny, and the market has been facing some challenges in the last year or so. Now, this is not new, and I think as market practitioners, we, of course, welcome constructive feedback, and we always follow an iterative process of improvement, also recognizing some of the challenges of the past. But I think it's important also to be thoughtful and engage in a constructive manner. Now, recent research, for example, by Trove, has shown that companies that do finance climate mitigation through carbon credits generally reduce their emissions faster than those not using credits. Partly because the financial expense of purchasing credits that puts a price on the emissions and provides an incentive to reduce, in contrary to, I think, the picture that many might try to depict of these markets. And of course, it's always easier to criticize those who are trying to do something than those who silently sit back. And I think we all recognize the importance of raising ambition across the board. But if you believe in the basic fundamentals of carbon markets, so the importance of channeling finance towards decarbonization efforts in the global south, in reducing emissions where it's least costly, and providing these important co-benefits to local communities, the answer, I think, is not to stop voluntary markets, but rather helping them evolve, increasing the integrity, expanding their size, and where possible, transitioning also into high ambition compliance schemes with international linkages. So on that note, what is being done? Well, I would say there's a lot, and I will not go into much of the details on this. But as I'm sure many of you also know in the audience, we have two of the main ones right now, being the ICVCM, so the Integrity Council for the Voluntary Carbon Market, who are kind of looking at this mainly from the supply side and has developed the core carbon principles, CCPs, for what constitutes high integrity credits. And now they actually launched the second part, which is the category level assessment framework today. And I believe this might have quite a significant impact on the market moving forward. But yeah, probably it's a bit too early for me to comment on what has been released today. And I'm not sure if Andrew might already have some reflections to share. But then on the other side, we also have the VCMI, so the Voluntary Carbon Markets Integrity Initiative, who has developed the Claims Code of Practice. And this one is looking at it more from the demand side and the claims that companies can make when purchasing and using carbon credits towards their net zero targets, which also came out very recently. So there is really a lot of movement on this front. Now, there's, of course, significant debate around both of these initiatives from various market stakeholders, which, again, I will not go into detail today. We also have the International Carbon Reduction and Offset Alliance, ICROA, which was launched already in 2008 to promote integrity and quality in the market. First of all, through the ICROA Code of Best Practice accreditation program, which certifies best practice in GHG emissions reductions and offsetting through the use of high quality carbon credits. And secondly, also through the ICROA standards endorsement, which essentially sets a number of foundational criteria for any VCM standard in terms of like governance, verification process, registry, environmental and social impacts, stakeholder consultations, etc., all with a view to strengthen integrity and create some common standards in the market. Now, finally, I won't take too long. I also wanted to just mention or touch upon the relationship and I think growing convergence between voluntary and compliance markets, whatever term you prefer to use, through Article 6 of the Paris Agreement. So as I believe most of the audience is aware, following the adoption of the Paris Agreement in 2015, which introduced the Paris Agreement, we got the rule book or the RMPs in Glasgow at COP26 in 2021, which has led to, and I think will increasingly lead to, reimagining of global carbon markets in the international space, where now with the Paris Agreement, all countries have their own nationally determined contributions, their NDCs, and all countries also have the possibility to link their markets and start trading on the international level, which again could unlock a huge potential in cheap abatement opportunities if used correctly. And whilst Article 6 does not regulate the VCM per se at the global scale, this has already started having significant impact on the voluntary market. And I think so far, mainly it has come through, unfortunately, an increasing uncertainty as countries try to basically understand the role of authorization and corresponding adjustments under Article 6 and the impact on their NDC achievement if they sell authorized credits under 6.4, or if being used for other international mitigation purposes, such as CORSIA. And what happens if they approve projects under 6.4, but do not provide authorization, in which case they can issue 6.4 mitigation contribution units, which was clarified in COP27, which, for example, can be used for voluntary claims without corresponding adjustments. And I believe and I see when I meet with governments that this is still a lot of uncertainty when it comes to how they want to regulate and interact with these markets. And also, for example, setting up national registries and standards and regulations in the countries themselves to get a better grasp of the mitigation activities that take place or that are available for them in their pursuit of the Paris Agreement targets. And probably another thing that, and I'm happy to expand on this maybe if there are questions, but a final thing that I believe we will really start see scaling up in the next years and decades as we move towards net zero is the role of removals. And this is also coming out quite strongly in the Article 6 negotiations and discussions right now, moving forward under the 6.4 supervisory body. And for removals, we're talking both about nature-based removals as well as negative emissions technologies that can help to lower the concentration of carbon dioxide in the atmosphere, which ultimately will be crucial to address any residual emissions by mid-century, and then also help us to restore and bring us back to lower global temperature means after reaching net zero. So these, I think, are some two probably key trends to look out for in the coming years in the market. And as IETA, we have produced a paper which covers most of these aspects I've touched on briefly here today. So there's really a lot of things happening in this space, and I would encourage you to check out the report that was produced by our members on the evolving voluntary carbon market. It sheds a light on the interaction with compliance markets, with Article 6, the questions of integrity and trust, and the mosaic of opportunities, as well as the issues and uncertainties. So you should be able to use the QR code here. Otherwise, I can probably also share the link in the chat. And it essentially talks about the same messages that I portrayed earlier on why is the VCM important, why to provide a robust mechanism for corporates to reduce or remove emissions beyond their value chain, to channel finance where it's desperately needed, and to pave the way also towards compliance markets. And finally, there is a call to action where IETA really wants to see the pace of investment in the voluntary carbon market increase at this critical time when the world rapidly is inching closer to the 1.5-degree target. And we need to rapidly increase ambition. And we think that the VCM can help do that in the short and medium term. So with that, I say thank you very much and hand it back to you, Gary.
Thank you very much, Björn. Apparently my video can't begin because I'm not the host has stopped it, but let me see. Thank you very much for your presentation. Really appreciate you taking us through some of the key issues relating to both national net zero, regional, as well as corporate net zero. I think this is an area that I think you've actually shed a lot of light. Before we go on, so once again, if you have any questions, I think you mentioned putting a link in the chat to that report. Very much welcome that. So if you can go ahead and do that, then the participants can pick it up in the chat as well. If you are just joining us, once again, a very warm welcome. Once again, please feel free to use the Q&A as Mr. Albert Chok has already done. Put your questions in the Q&A. We'll address them after both presentations this evening. And if you look at the Q&A, feel free also to upvote any questions that you see that you want prioritized. All right. So we'll move on ahead to our next presenter this evening is Mr. Andrew Howard. He's Senior Director for Climate Policy and Strategy at VERRA. And Andrew will be talking about the relationship between the voluntary and the compliance markets, and also touch on issues of quality of credits. So with that, Andrew, feel free to share your slides. Thank you.
Good. Thanks very much, Gary. And first of all, thank you for the invitation to join the webinar and to speak today. Indeed, as Gary has just said, what I've wanted to do here is to take you through some aspects of the voluntary carbon market, how it relates into the bigger picture, and particularly some of the things that Björn has just been talking about with the Paris Agreement. I'll touch very briefly on some of those, and we can also go into more in terms of the Q&A afterwards. But also to talk about quality and to talk about how credits are being used in the market. And these are very topical indeed. Björn has already touched on quite a number of these things at a higher level. So hopefully what I'm going to say here will complement things by perhaps going into a little more detail on some places, but I'm also happy to go into further detail later in the discussion that we have. So let me just share the screen. Right, hopefully you can see this. Yeah.
Yes, we can, Andrew. We'll proceed. Yeah.
Right, sure. So first of all, just very briefly on VERRA, in case you don't know us already, we are an independent crediting program, very active in the carbon market. We've been around since 2007. There's been just over 1 billion credits now, which have been issued to date. As Björn said, in terms of the voluntary carbon market, the market is quite small compared to compliance markets, but it is also growing. And there's over 1,800 projects currently within the system. We have the verified carbon standard, the VCS. That's actually the largest standard that there is, certainly within the voluntary carbon market, but also when you look at crediting overall, it's a very large share. We also offer several other standards in the jurisdictional RED space, reducing emissions from deforestation and forest degradation, but also in sustainable development. We offer a couple of different programs in that area as well. And it's possible to layer them together so you can build up sustainable development characteristics on top of the carbon. So, okay, so first of all, I want to say a little bit about the bigger picture and how it fits in. There's often a lot of talk about voluntary markets on the one hand and compliance markets on the other hand. And I must say, from the perspective that we have within the market, we certify projects, they produce credits which we issue, and these are valid on both voluntary and compliance markets. Of course, a regulator, and for example, the regulator of a carbon tax needs to formally accept our credits within their system. But there have been several countries which have done this already. Colombia, Singapore, South Africa are a few of the prominent examples. And what's important is that we have the same MRV, the monitoring, reporting, and verification standards, which then follow through for all of these credits, no matter where the destination is, whether that's voluntary or compliance markets. So when we think about compliance and voluntary markets, it really comes down to there being a difference in the motivation for actually going out onto the market and buying the credits. Sometimes it's driven in the voluntary context very much by corporate pledges. These have up until now been mostly in around the area of carbon neutrality, but this is increasingly moving across into an enterprise level claim around net zero trajectories and meeting net zero at some point in the future. There are currently over 3,000 companies which have set net zero targets. We often think about the Science Based Targets Initiative, SBTI, in this context, and certainly it is a very large share, but a lot of companies are also doing it on their own. This is, of course, a little bit more dangerous because initiatives like SBTI bring much more standardization, and it's much easier to say exactly what the net zero target means when it's done within a particular framework. And then, of course, on the compliance side is driven by the regulatory obligations that the company has, whether that's an obligation to pay a carbon tax, which can then be somewhat reduced if there are credits which are surrendered in place of paying the cash as a carbon tax, or of course within an emissions trading system, where credits can sometimes be surrendered in place of an emissions trading allowance. And I think there's been previous discussions through this webinar series as well on issues like these. Just to touch on a few of the impacts that we're talking about with crediting projects, just to focus on the first two. Corporations taking action, of course, for corporates, the incentive that they have is to reduce the climate footprint that they have, or if they can at least measure what the footprint is through their inventories, then they can make sure that the action they're taking is in some way commensurate with the level of emissions that they have. And there are different methodologies which are coming out in terms of how exactly the level of expectation of how much crediting can happen. There's views coming out, and there's consensus arriving around these. Another area is driving finance into climate action, and this is very key, because whether we're talking about developing countries or actually sometimes projects in developed countries, the finance flows into these projects through the carbon market generally because the finance is not available from other sources. And it's important to see the finance which is available in the carbon market is very much complementing finance which is available through other sources, whether that's through public finance arrangements, particularly between two countries. And of course, the Paris Agreement has a lot of aspiration in terms of that. Governments are not always so forthcoming in practice with the actual provision of that finance. And therefore, it is very important that you have opportunities like carbon markets where companies can step into the breach and can also contribute to that delivery of finance. So these are very key impacts that we have through the crediting of projects on the voluntary market, and it's very much akin to the way that finance flows as a result of compliance programs as well. Just some figures here. Björn's already shown you some, I think, on a longer time series. I want to focus here on the extent to which independent crediting programs actually dominate the market as we have it today. 2022 did see a rise in clean development mechanism. That's the clean development mechanism under the Kyoto Protocol. So we saw in 22 an increased issuance from that mechanism. That mechanism is actually being phased out at the moment, with the Article 6.4 crediting mechanism coming in to play under the Paris Agreement. So maybe that was a last flush from the CDM. But if you look beyond that, the bluish colored columns here are different independent crediting programs which are active in the market. And the light blue one there, the biggest one, is for 2022 is our VCS program. So there has generally been a very strong growth since the Paris Agreement was signed off in 2015. You could see the longer time series from Björn's slide. We've also seen in this period a lot of new programs coming forward, accrediting programs, and a lot of them are very small. There are some where I think there's certainly some robustness which is still missing within the programs, and what you've seen, I'll talk very soon about the ICBCM, is you have initiatives like the ICBCM, the Integrity Council for the Voluntary Carbon Market, coming in order to try and make sure that all crediting programs actually do deliver to a higher quality standard. Market growth is expected to continue. We saw some other figures from Björn's slide. These figures here come from the task force for the voluntary carbon market, for scaling the voluntary carbon market, which was active until the ICBCM took over. And generally speaking, they're talking about a 15-fold increase in the level of crediting issuance and also retirements of the credits in the period up to 2030 and 2050. So we are talking about an enormous increase. And one of the perspectives that we have on this as a crediting program is we're going through a lot of internal work at the moment to completely revamp the way that we actually go through the processes of certifying projects and issuing credits. And in order to be able to achieve the scale, there needs to be a lot of movement beyond the way that we're currently working. And I think that's a general message across all of the independent crediting programs. In fact, also probably the regulatory ones as well. In case you don't know already, our credit is called the Verified Carbon Unit, the VCU. Like others, this is 1 metric ton of carbon dioxide equivalent emissions. We issue it onto our VERRA registry, and that's where they're retired also. So when a credit is retired, it can be attributed to a specific entity in terms of the purpose that the entity is retiring the credit for. If it has a target or a commitment, then it's able to count the retirement of that credit towards that target or that commitment. That's the way the compensation claims work. That's the traditional model that we've had under the carbon market to date. You may already know this as well. This is a schematic of our project cycle, so I won't go through them. There's a lot of detail which sits underneath this, but I won't go through that. But essentially, a project, once it actually gets listed on our system, needs to go through a series of checks. The first part is it goes through a third-party validation. So this is where an independent auditor comes in. We call them VBBs, validation and verification bodies. And they essentially ensure that the project does meet all of the requirements that we've set through our standard. It then gets registered on our system. And once it's registered, then it can go through an ongoing cycle of monitoring, third-party verification, and then issuance of the actual credits. So this is, I think, a model which was set up by the CDM when the CDM was first established under the Kyoto Protocol, and all independent standards follow, roughly speaking, this kind of process. They may have different expectations for the validation and the verification and the way that's done through third-party sources, but the cycle itself is not so dissimilar. Quick word on the types of activities that we have within our program. These are the different activity types that are available on the voluntary carbon market. Is actually 2001 data, but it's still pretty much the same. The percentages may have changed just a fraction since then, but you can see that forestry and land use on the voluntary carbon market is the most significant share. This is led largely by our VCS program. Renewable energy is also very prominent within the market, with another just over a third of the crediting which occurs. And a brief word as well on the Sustainable Development Goals. I mentioned earlier that we have two Sustainable Development Programs where you can layer the characteristics and the achievements of impact under the different Sustainable Development Goals, the SDGs. You can layer those over the top of the VCS. We also have provisions within our VCS program itself to already take a first tier assessment of what SDG impacts are occurring. This has been traditionally seen as a co-benefit within the carbon market system, and increasingly it's really being looked at as integral to the way that crediting works. And it's not only important to ensure that there's actual carbon reductions or carbon removals which are happening, but also the project has to do it in the right way. And that's where the SDGs come into play very much. So a few words here about quality. And here I'm drawing also on this morning's announcement of the ICBCM's core carbon principle labels. This in many ways is not new. Certainly our program has been doing all of these quality criteria for a long time. They actually make up the bread and butter of a crediting program. When what the ICBCM has done is it's looked across the voluntary carbon market, and it's looked across all of the crediting programs, and it's really worked out, well, it's defined and structured what the particular requirements are, which can ensure that a crediting program delivers the kind of quality threshold in the supply of the credit that they're looking for. It's a useful structuring of the different characteristics, and all of the crediting programs, at least all of those who apply, will go through an assessment by the ICBCM, and it'll be very interesting to see what the results are. At VERRA, with our VCS program, we're quite confident that we will pass the requirements. As I said, this has been the bread and butter for established crediting programs for really since our inception. On the governance side, there's a number of issues around the way the system is governed, obviously the way that decisions are taken, the way that policies are enforced, but also the tracking is very important. That's where our registry comes in. So we're always aware of what has been issued, who is holding the credit, what has been retired, ensuring that a credit is only retired once. One of the initiatives that we have at the moment is to restructure the way that the attribution of the retirement towards specific purposes is done, so we can give that an overhaul and make it much more targeted towards the future uses of credits which are appearing. And the other aspect of governance is the ensuring an independent third-party validation and verification process. So I mentioned that before when talking about the project cycle. This is really key to underpinning the quality of any credit which you can buy on the market. Emissions impact is also very key. This is one which is split between requirements. This is where the ICBCM does it. It splits emissions impact criteria between considerations made at the program level and considerations made at an individual project type level, or they call it a category level. This concerns additionality. We have to be absolutely sure that the project would not have gone ahead without the incentive which is provided by the voluntary carbon market credit, or the revenues from the credit. Permanence, and this is particularly an issue for nature-based solutions. It's very important that once the emission reduction or the removal has taken place, that it actually remains out of the atmosphere. And we know that sometimes there are reversals in removals which have been made. This is something we have to live with and work with, but it's very important that when this occurs, there's an appropriate compensation. So we have a buffer in place, and we, in event of a reversal of a removal, we compensate that reversal from the credits which get built up in our buffer. And this is a policy which was initiated by VERRA many years ago, and it's become very much the standard operating procedure for working with permanents. And also very key is to ensure the robust quantification of emission reductions and removals. So this really goes into the individual methodologies for calculating what the baseline should be, that is the reference level, which we then compare the emissions from a project against, and working out how exactly to monitor and how to verify the quantity of emissions which are occurring. No double counting is also very key. It undermines the whole system if there's double counting. So if, for example, there's an emission reduction which is resulting in 2 credits being issued, this is the kind of thing which undermines the system. And sustainable development, I mentioned earlier on, is becoming very key and not just a co-benefit anymore. That touches on the SDG impacts that I was talking about before, but there's also a number of safeguards where a project needs to ensure that it's not doing particular harm to communities and to ecosystems and so forth. And contribution to net zero transition, this is something which is quite new for the voluntary carbon market, and it's being brought in quite strongly by the Integrity Council. And here we see essentially that there's a wish to avoid the types of activities within the voluntary carbon market which are actually perpetuating the use of fossil fuels. So, for example, the ICBCM is looking at not allowing particular activity types to receive the CCP label, the Core Carbon Principle label. So I use the ICBCM here to describe quality, but as I say, this is something which is what crediting programs are always working on and are always trying to improve. It is very much a situation of continuous improvement. There's constant work to revise the standard and the methodologies which we're using. I was asked to say a few words about deforestation. I know, of course, in the Asian region, this is a very key activity type. And it's also been one which has been criticized very heavily recently. VERRA, as an organization, we still stand very much behind the need to pour finance into stopping deforestation. And it is a really essential measure that needs to be taken now. And where we are somewhat concerned about the level of criticism there's been is that a lot of companies are beginning to shy away from some of these activities. And that is a problem because deforestation is one of the immediate measures that the world needs to be taking. We've actually had a program of work in place for a couple of years now, and it's now coming to its culmination point. In September, we're releasing a new consolidated methodology for how to calculate the emission reductions when you slow or stop deforestation. And there's a number of issues that it's trying to address, particularly the concerns that I've mentioned here around how reference levels or baselines are set within RED projects, how there's actually quite technical modeling of forest losses and whether that's actually overestimating the amount of forest losses which would be occurring under the baseline, and also some technical inconsistencies between the multiple methodologies that we've had in terms of locating where deforestation activity is happening. So what we're doing is we're bringing out a consolidated methodology. This is beginning with the area of avoiding unplanned deforestation, which is one of the components and the largest component of RED activities. So we're bringing that out in September. We are primarily relying on this to begin from a single data set, a jurisdictional data set of what deforestation is occurring and what activities are happening as a result of action against that deforestation. And then for each project, it's a matter of allocating deforestation rates in the baseline project by project. and that's done on the basis of the level of risk which is measured within a project area. So the jurisdictional baseline does a number of things. It first of all, it caps the risk that these projects, when you add them up in a jurisdiction, are overestimating the amount of emission reductions that are occurring. And secondly, by giving the very objective data, we can be much more confident in the results of projects which are coming in. And we are confident right now in results as a whole, but we are also aware that there are some circumstances where the methodology doesn't completely ensure that the emission reductions are perfectly estimated. We are then transitioning across to this new methodology. We're requiring that by the end of 2025, all projects, whether they are currently in existence or whether they're new projects coming in, that all projects will be using the new methodology by the end of 2025. Okay, I'll finish up with a few words on claims. And this is also an extremely important area. I think the voluntary carbon market has traditionally dealt with a lot of quality issues on the supply side, making sure that the credit is a valid representation of an emission reduction or removal that is taking place. And that is continuing, of course, to be very important. And that is the subject of the ICBCM publication of its assessment framework that has come out this morning. But there's also a very important area which needs more attention, and that is the way that credits, once they've been purchased, once they've been received, how those credits are actually used towards the commitments that a company is making with regard to carbon neutrality or with regard to a net zero target or some other kind of reduction target. And there's a number of factors which feed into the fact that we do actually need quite a significant overhaul of the way that we've been dealing with claims to date. Firstly, and this is very important, there's, some time ago, it was sufficient for a company to be going about its normal business, but then offsetting its emissions. And of course, there are companies which have been reducing their emissions at the same time, but it's increasingly the view that the focus really needs to be, in the first instance, on companies reducing their own emissions, not only at a particular measuring them at the product level, but also measuring them at the full enterprise level through having the right inventories, but then also setting targets and making sure that claims are tied into those targets. So offsetting isn't enough. The mitigation hierarchy needs to be followed. This very much says that we need to avoid the emissions that we can, first of all, and reduce those emissions. And then only after we've reduced emissions do we look at buying in credits to compensate for what's left. I think there's been a number of consequences coming out from these kinds of discussions that we've had, particularly around falling confidence in the claims that companies are making and accusations of greenwashing. I think you're aware of these issues. So the last slide here, this delves in a little more deeply into what the VCMI has been doing, the Voluntary Carbon Market Integrity Initiative. This came out at the end of June with a code of practice for how claims can be made by companies. And you may well have seen this already. It does make quite significant changes in the way the claims are looked at, but the work is also not finished yet. So the graph here tries to represent what is going on here by showing different opportunities for the way that credit can be used. And this focuses on what the VCMI has been doing with the compensation model. So the compensation is kind of the new word for offsetting. The first opportunity here is that where you can see that a company has been able to get its emissions down from the blue dotted line of its baseline down to, in a very successful way, the green net zero trajectory. So this net zero trajectory leads to net zero emissions in 2050, or hopefully much earlier than that. But the trajectory is very important, and the trajectory is set up by a number of interim targets, which need to kick in before the full net zero target at the end of the period is concerned. So if the company is successful in getting the emissions down to that green line, the net zero trajectory, of course, there are still a lot of unabated emissions. And what the VCMI does is it distinguishes platinum and gold and silver claims by the level to which these unabated emissions have been compensated or offset. So 100% compensation, you get a platinum medal, whatever it is that is given out. And I think between 20 and I think between 60 and 100%, you get the gold label, and for between 20 and 60% compensation of the unabated emissions, there's the silver. So that's where the VCMI has come out in its final guidance, and it'll be interesting to see to what extent this will be taken up. There are actually very, very few companies that currently meet all of these requirements, and bearing in mind that they have foundational requirements as well in terms of having an inventory and a science-based target and so forth. A second area is still controversial and is the subject of a further work program by the VCMI through the rest of 2023. And this is to say that where a company has some difficulty in getting its emissions down to the net zero trajectory, there may be some grounds for using credits in a compensation style in order to complete that journey down to the net zero trajectory. This is quite controversial. The SBTI has certainly come out in the past saying this should not be done in this way. The VCMI is still considering it further, and there is a lot of business interest in being able to pursue a model like this. What is very important is that it should be a temporary measure, if it's allowed at all. So it needs to be bound in terms of time and also in terms of volume, because if this is taken advantage of, then we could get to a situation where the efforts to reduce emissions is being undermined. The third area of where credits can be used in its compensation model is the residual emissions under number 3 here, and that is when you get to net zero, there's actually going to be few sectors which completely eliminate their emissions. There's always some, or there's generally always some emissions which are expected to remain, and these will need to be compensated with removal credits, not with reduction credits, but with removal credits. So that's where claims is going currently. There's also another type of claim which I had not put on this slide, or in fact any slides, but it is also gaining in momentum, and that is around contribution claims. So this is where a credit is still purchased in the same way, but the way that it's claimed is the claim is simply made that the company has helped either global mitigation efforts, or it's helped a particular host country to reduce its emissions, and doesn't attempt to then integrate that number within its own commitment, meeting of commitments. So that's a contribution claim. It has traditionally not always been seen with a lot of favor from the business community, which I think is still very much tied to the idea of having a unit that you can trade. But I think it does warrant more attention, and perhaps it will also gain more popularity in the future. So thank you very much.
All right, thank you very much, Andrew, for a very chock full of information presentation. It's been really helpful. If you would unshare the screen now, and if I could ask Björn to turn his camera back on. Thank you very much. So thanks. And before we get into the Q&A, once again, we've got 3 questions in the Q&A already, but I'd like to encourage the participants to go ahead and keep those questions coming. I do have some questions here which I will throw in intersperse them with what has been provided by the audience, but I'd rather not, preferring to give priority to questions from the participants. All right. The questions don't look like they're directed particularly to any one of you gentlemen. So perhaps who would volunteer to take it. In fact, both of you, I think, could try taking these questions. First question concerns sort of an internationally agreed framework for the pricing of carbon credits. If not now, sometime in the future. I think I've given out the answer a little bit, but I'd like you to address that. Question is from Albert Chiok, is there an internationally agreed framework for the pricing of carbon credits? Yeah, well, do you want to go first, Björn? You smiled.
Yeah, I'm happy to. So I think, thank you first of all for the question. I think you can probably read it in a couple of different ways, and I would see this question basically as how do we get towards a uniform international price on carbon, right? So there are various ways to also see what does that mean. And as mentioned before, we have been doing also some research together with the University of Maryland and IETA, which actually deals with this question. And for me, I always like to go back to the fundamental principles, right? So what is a carbon market? Why do we have it? One, because we realized that it doesn't matter where emissions are reduced. 1 ton of CO2 is 1 ton wherever it's released. And 2, as according to very classic economics trade theory with comparative advantages, there are differences in marginal abatement costs between countries or companies or sectors. And this is what allows the trade to happen. And for both parties that take part of that trade to gain from it, either it's from the sales or from the revenues or from the cost savings. And with the Paris Agreement and science, it tells us we need to reach global net zero by mid-century or earlier. We need to reduce emissions by 45% until 2030, right? So that will require a lot of finance, and there are always other competing interests. So we want to do it as cost effectively as possible. And that is exactly what carbon markets can help do, whether it's voluntary markets, it's domestic emissions trading schemes, or international under Article 6. And when cooperative approaches under Article 6 really becomes significant is when, assuming all countries need to reach net zero, albeit with different timelines, they all participate in this trade, meaning that over time, we will meet in the middle where this fair trade creates the gains for both. So if you extrapolate the results of basically nowadays, the countries with low marginal abatement costs will sell credits at a lower price. They will sell it probably to the ones with the higher cost. And over time, we will meet in the middle and that's when we will also kind of have an international carbon price. So it's kind of like, sometimes I like to reference it, and I'm not sure everyone agrees. Happy to also hear your views, maybe Andrew, on like a global ETS with a soft cap of the existing NDCs and the trade, of course, taking place voluntarily between the obligated entities, which in this case actually is the countries or the parties. But then, of course, also as Andrew mentioned, like in the presentation, there are also other values or co-benefits that can be assigned to projects and credits, which of course also might push the price higher than the purely reflecting the marginal abatement costs, like local communities benefits, gender, biodiversity, air quality, etc. And in the VCM, I think it's very it's not a bold assumption to say that the CCP labeled credits will see a higher price premium, at least in the near term. So those are just some reflections, but happy to hear other views.
Thank you very much, Björn. Andrew?
Yeah, and I very much echo what Björn has already said. I think just to focus on a couple of points there, I think certainly as far as credits are concerned, I think we will always see that there will be quite a distinction in pricing between different project types and different SDG benefits. And I think that's already emerging, and we can expect that to occur in the future. And I think as crediting programs are also able to better delineate what the impacts are, we may actually see more divergence in the pricing. But it is a divergence in pricing which is based on specific qualities of the project. So it's not due to market failure as such. They're actually different products. I think this does very much bring in the question about the I often refer to it as the dream that we used to have. maybe some still have it, in terms of whether we'll get to a global market. That was certainly the discussion that we've had at the beginning, and I think it does remain the aspiration. And economically, certainly, it's a much more efficient outcome, and you can have many more reductions at a considerably lower price if we were able to have more of a global market, or at least very large regional markets at play. I think in practice, what we've seen is that there's a lot of political barriers to that occurring. And when you look at, I think, close to a decade that it took the EU and Switzerland to sign their linking agreements for their emission trading systems, there are very large challenges, and there are very different worldviews and different perspectives that different regulators have. So they're not always ready to come together and to make things work. I think a notable exception of that has been the Western Climate Initiative in North America, where from the very start, before the countries started joining up, they set the rules. And I think if there is to be a global market, then that's the kind of thing that needs to happen. There needs to be an agreement on the rules before countries have started creating their own systems. But perhaps we're a little late for that. I think there are a lot of benefits, though, and I do expect this to happen, that there'll be consolidation, perhaps at a regional level, at national level first, and then at a regional level. And then perhaps later on, you'll have more linking across different regions as well. One of the benefits of credits, if I can just sing the praises of credits for a moment, one of the benefits of credits is that they can be a fungible unit, which is then sold into any market. So whereas two countries are going to struggle for 10 years before they link their emissions trading systems, like we saw with the EU and Switzerland, you can have credits which are then acceptable in compliance programs all over the world. And once they're accepted into the compliance programs, then they can also feed into the country's achievement of their nationally determined contributions, the NDCs, under the Paris Agreement. So there is a lot of potential for crediting approaches to bridge some of the political barriers that we have in joining up our systems.
Yeah, thanks very much, Andrew. A very quick question, maybe. This one comes, the second question from Albert, essentially asking if cattle farming should be discouraged since livestock produce a great deal of methane, fossil fuels. Maybe we can reshape that question a little bit to ask if in your portfolios you see any livestock programs that have come in proposals to reduce emissions from livestock operations. Maybe that's a better question, or more appropriate question for the both of you. Since you have the floor, Andrew, do you want to go first?
Sure. Certainly the question as phrased does bring up lots of political issues amongst those proponents of eating meat and those proponents of eating plants. But just on that, no matter where you stand on that debate, I think the facts are very clear that a plant-based diet has considerably less emissions attached to it. So I think that's undoubtedly and unquestionably true. Yes, there are crediting project methodologies which are available for livestock emissions, and for they generally don't work in the area of reducing cattle numbers, but they do work in the area of changing cattle feed and this sort of thing, and changing the way that livestock is managed. So there's definitely opportunities there in that space to generate credits from those from this industry.
Thank you. We've got an anonymous attendee who asks, how does carbon insetting, I'm not sure what that means, carbon insetting, which means supply chain focused rather than sector, how does that fit within the narrative of credits, especially after considering the added verification complexity of jurisdictional mechanisms, double counting, etc. Can I direct that first to Björn?
I think I would leave that for Andrew to start.
Andrew, okay, very well. Andrew, if you would then, carbon insetting.
Yeah, I mean, this is a very complex field, but and I'll try to say a few things on it. I mean, first of all, for those who are not familiar with the term, insetting refers to reductions in emissions which are made within a company's supply chain. Whereas offsetting is really looking at emissions reductions and removals which are outside the control of the company. Insetting is focused on reductions which can be made within the chain of control that a company has, whether that's in its upstream or downstream chains. It is something which is quite complex to then fit into the current models that we have. VERRA is developing currently a Scope 3 program, which is very much looking at this area and trying to see where the kind of MRV systems that we have in place would have been built up for an offsetting context can also be applied within an insetting context. And the particular rationale for that is because when a company reduces its emissions in a supply chain, for example, so it doesn't actually have currently a very strong set of tools to use. There are essentially changes to the way that emission factors are determined, which can then change the inventory. That's a Scope 3 inventory which a company is putting together. Those are quite blunt tools, and we're trying to work within our set of tools to find ways where the MRV that we've built up for offsetting can also be applied within an insetting context, and where you can actually then also generate a credit. So you'd actually have a quantified estimate of how much the reduction is, which is of sufficient robustness and credibility to generate a credit of it. And one of the advantages of that is that we know that supply chains change over time. And one of the problems that the insetting industry has been facing is that you could well have a project which is invested in a supply chain, and then for other unrelated reasons, the supply chain changes. So a company may buy its supplies from a different producer, for example, and then all of that investment is lost. And by applying the kind of MRV tools which we've built up from the offsetting world to those, we can generate a credit which can then switch between the insetting and offsetting worlds and can be used for those different purposes. So it's a complex area, but I think what we've seen is that the whole industry there really needs a stronger set of tools to work with, and that's what we're trying to give.
All right, thank you very much. Anything to add, Björn, with that?
I think Andrew covered that very well.
Okay. All right. Okay, I'd like to put one of my questions in at this point, if I may, and maybe we can go with slightly shorter answers so we can try to get to more questions. One of the questions we frequently get from businesses is that they've already taken some action. Maybe they've installed a heat recovery system with a gas turbine generator or something, it used to be under the CDM that you couldn't do this kind of thing unless you had a sort of a statement, a letter of intent showing that the activity that you wanted to spend your out-of-pocket expenses on investments, whatever, were going to be put up as a project for generating credits, and that you were willing to sort of fund it initially yourself out of pocket, with the idea of generating credits and recovering some of that. So many times when we get that question, we say, well, of course, all the other things about additionality do apply. Is it profitable? Is it bankable? Is there any social barriers, etc.? But is this something that you see surviving moving forward, initially out-of-pocket expenses, as long as you have a strategy or a plan in place in writing that says what you intend to do? Either gentleman. I'll start with Björn.
Yes, I would say maybe I'm not completely clear on the question, but I mean, also under Article 6, of course, you need to, if you wanted to generate credits, well, if it's under 6.4, you need a letter of approval, first of all. So you need approval from the host country in order to register the project. And then if you wanted to generate credits with corresponding adjustments, you also need an authorization, which is a different part, right, of the process. And the authorization letter is where the host country, of course, the government, would basically say what types of uses those credits can be used for, whether it's other international mitigation purposes, such as CORSIA, as well as international transfers for use towards NDC achievement in other countries, or in which case they don't need the authorization letter and it can be 6.4 mitigation contribution units.
Okay. All right. All right. Andrew?
Yeah, I must say I also didn't fully follow the question. Okay. Are you referring to prior consideration?
Well, yeah, sort of prior consideration, or actually right. Companies that have indicated that they were willing to invest out of pocket, but then came after the fact, sort of, and said, how do we convert this to credit? So the idea on the CDM, of course, was that it couldn't be an afterthought. You had to have evidence right. that you prior to the investment actually intended to get this financed by credits. But right. Just if there's anything to add.
Right, indeed. And so what the regulators are looking for is evidence that the company has not just simply seen an area where emissions are being reduced through no actions of their own, and then they create a project around it in order to generate credits, which should certainly not be allowed. And yes, it wasn't allowed under the CDM, and it shouldn't be allowed now. So I do think that those kinds of provisions will continue to be in place. In fact, the ICBCM has it as one of their requirements. There are actually different ways of being able to do it, though. So, for example, VERRA, we don't actually have a prior consideration provision within our standard. We manage it in other ways. What we're considering at the moment is that there would actually be a maximum time period between when a project gets listed and when a project is submitted for registration, in order to reduce the amount of time between when we have evidence of the project being considered for the first time and when it actually gets registered. So there's different ways of handling it, but it continues to be a priority.
Yeah, okay. But a question here from Datuk Lutuk Yi, but she didn't put it in the Q&A, she put it in the chat. And this may be a question that you gentlemen might have information on, it might not. Question is, are there any CDM projects from Malaysia that have successfully migrated to the Paris Agreement? And since I've retired from the government, I'm not privy to that information. Would any of you have that information?
I mean, I can share just basically the process, right? So actually the 6.4 supervisory body recently opened the request for transition for CDM projects to the 6.4 mechanism. So if you are running a CDM project right now, you can request to transfer to the 6.4 mechanism, and that ends by the end of this year, so 2023. And then I think that has to be basically, first of all, accepted by, of course, the host country, as well as by the 6.4 supervisory body applying the new 6.4 mechanism methodologies, which are still under development. So there is some uncertainty to it. So basically the short answer, I think, is 0. And the long answer is we don't know which projects might transition. But of course, then you also have the transition of CERs, so existing credits. But maybe Andrew also has some deeper analysis on this.
Andrew?
I would echo what Björn has already said. So the process is in place, but I don't think any have actually made the transition. What we have seen is a lot of projects have been coming from the CDM across into our VCS program. And that's an interesting strategy because by then generating credits under the VCS, they can return, the credits can return into compliance markets or be used for voluntary markets. But certainly the market for CDM itself is dwindling. So we certainly understand that there's a need to move the projects and the credits out.
I have a question from an anonymous attendee. This is directly at VERRA. Do you happen to have a program that provides a zero-fee initial assessment for carbon potential, or for credit generation potential emissions? That's a very quick question.
No.
Okay, right. Then we'll follow that up then with, so we'll follow that up with the next question. What is VERRA's role in nature-based solutions, sustainable forest management? I know that you already mentioned something that you have from unplanned deforestation, but do you have a slightly more general statement about nature-based solutions and forest management? For example, maybe talk about the extended rotation provisions.
Firstly, just very briefly on that last point, the reason we don't have a program like that is because what we do is we certify projects. We don't enter into consultancy work to work with potential project developers. On the question around nature-based solutions and our role within that, I think the general answer to that is we certify. The role of our organization is to receive applications from projects and to ensure that those projects are robust and that the estimates of reductions and removals are credible. So therefore, we don't have any role in developing the projects. We don't have any role in supporting them or seeking finance for them. We simply provide a way of a framework for applying the MRV in order to make sure that the resulting credits then are legitimate.
Okay. And what I spoke about the cutting cycle extension. Maybe our question is, in the area of forest management, are there any schemes that allow any kind of selective harvesting or long cycle harvesting or extended cycle harvesting? Because I think, as many pointed out, the demand for timber is not going to go away, but it's just how these things are managed. And perhaps Björn, you'd like to add something to that after Andrew.
Yeah, and well, I'm not a deep expert on these issues, but certainly our methodologies do allow for sustainable management of forests, which there are certainly circumstances where some degree of harvesting can happen, but it needs to be done in a sustainable manner.
Anything to add, Björn?
I think not on that part, but I also saw the other question here in the chat on unabated emissions.
Yes, maybe you could answer that. Yes, I was going to pick that up
versus
next.
dated. So yeah, I'm actually not sure whether there's like an internationally uniform definition, right? But generally very simple. I would say that abated emissions talks about where through some means you have reduced the intensity of emissions by various approaches. And for example, I think probably the most common discussion here is for fossil fuel power plants, where you, for example, deploy a CCS or carbon capture storage facility, in which case you, of course, reduce the intensity of emissions, but you do not completely counteract the full emissions from that point source.
Okay, so just a little time check here. We are at 7:22. We scheduled to end at 7:30. So what I'll do is I'll ask another question. This is with respect to wait, which one should I guess corporate net zero. We get a lot of questions, in fact, from large companies. When they talk about quantifying their scopes 1, 2, and 3, they often conflate that with the need to offset scope 1, 2, and 3. And they ask, well, isn't that double and triple offsetting if I'm offsetting somebody else's scope 2, or somebody I'm offsetting my scope 2 and my scope 3, that is actually somebody else's scope 1. Maybe you could clarify a little bit on that. Are companies who actually declare net zero, when they talk about their supply chains, are they expected to offset their scope 3 emissions, for example, when they actually scope 1 emissions of somebody else? Perhaps Björn, while you're on, you can go first, and then after that, Andrew. And then after that, I'd like some closing remarks in the way of advice. What advice would you give to corporates thinking of moving, or making a net zero pledge and then moving on that? So we'll answer this question, and then we'll begin with Andrew on that closing remark, and then come back to Björn. Go ahead.
Okay, thank you. So yeah, I think basically all companies, first of all, should always be encouraged to, first of all, estimate and then measure both scope 1, 2, and 3. And as we all know, scope 3 in itself is quite a challenge for many companies, because there is not just one category. I think there's 15 categories in the scope 3 guidance. And of course, depending on the company, the sector, and your supply chain, you might have a better or worse understanding basically of where your emissions lie, and also the amount of control you have over the emission supply chain. And in terms of, so that's number one, right? And I think all companies should also probably set targets which relates to both 1 and 2 and 3. So, and these might not necessarily be all the same. And those who set net zero targets, of course, there are various standards for this, and maybe Andrew can also expand on that part. But if you set your net zero target for 1 and 2, well, that's the part that you will probably offset any residual emissions for. Whereas if you cover probably certain categories of scope 3, not necessarily all of them, but we know, of course, certain categories like business travel might be easier to include under the ones that you have more control over, and which probably you can also offset in order to claim carbon neutrality or net zero. Whereas others, of course, might be more difficult. And I don't see it as bad necessarily if there is a double offsetting, right, in the value chain. Actually, it's positive if I offset for my emissions further down the value chain, and these companies also are doing it. It means we are doing more and we are increasing ambition. But yeah, that's my response to that question.
I hate to flip the order of what I planned, but I do recognize that we have 4 minutes left, and I know you have a hard stop at 7:30. You have to go, so maybe I can let you begin with the closing remarks with respect to what steps, first steps, companies that wish to maybe make some net zero targets might want to take.
Sure, thank you. Now I didn't have time to think of my advice here, but I think it's quite simple in a way, right? We all need to increase ambition across the board. We need to first understand our emission sources. So very simple, right? Like monitor, measure, and then set your own targets both internally and for the value chain. Offset existing emissions, use high quality credits, promote both voluntary markets, but also, and I would say this is an important part, right? As corporates, we need more stringent regulation, both domestically and internationally, so that we can move towards our common global net zero targets, because we are still very much off track and we need everyone on board. So that's it. Thank you.
Yeah. Thank you very much, Björn. And I like once again appreciate you being with us this evening. It's afternoon for you. Oh no, you are in Singapore, so it's this evening for you as well. But thank you very much. If you do need to leave, please go on ahead. It's been a great pleasure, and thanks for joining us. On to Andrew, that first question. Yeah.
Around steps that can.
No, before that, just the issue of
the scope 3.
Yes.
Yeah. Well, I agree with what Björn has already said. I think it is true that there's an overlap of emissions responsibility, if you like, between what is the scope 3 emission for one entity and a scope 1 emission for another. That is true. But I think the purpose of incorporating scope 3 emissions into your inventory is about taking responsibility for emissions that are actually attributable to the actions you're taking. So yes, there is an overlap, but I have to say I'm less concerned about the overlap. And I think that overlap is only really going to be an issue when we get to the point where everybody is taking so much action that we're reducing emissions way beyond what is necessary. But I can't imagine ever being in that situation. So I'm not worried about that overlap.
Well, yeah, I guess it's just a discussion that might arise. In fact, that if you've got your supply chain already reporting, measuring and reporting the scope 1, and then offsetting the scope 1, and then you're reporting scope 3 and saying, well, it's already been offset, so why do I need to go and offset? It's just a question we get from time to time. But I'm happy to hear that in general the consensus view might be that it's a good mistake to make is multiple offsetting.
Right. Yeah. I'm not sure I would even call it a mistake.
Yeah, exactly. Yeah.
Certainly, that overlap is there. That's
yes. And then, if it's all right with you, your closing remarks and what steps?
Yeah. So, what advice would I give? I mean, Björn has already outlined the kinds of steps that a company would need to go through. I think I would add 2 more emphases on that. One is follow guidance, and that is important because a net zero goal is only important when it is well understood, and when it's understood by people outside, by civil society, by your consumers, by your investors, and that's where it's necessary, as more and more companies move forward on net zero goals, that we actually have a consistent framework within which is being done, so we have comparability and we understand what's really happening. The second thing I'd add is be bold. Be bold. I think this is increasingly something which your consumers and your investors will really be looking for, and looking for companies who are taking this seriously.
Okay. Thank you very much, Andrew. So once again, Björn Fonden and Andrew Howard, our guests this evening, panelists. It's been a great pleasure. You've been extremely informative. Thank you both very, very much. Also to you, ladies and gentlemen, who are joining us, thank you so much for attending our 3rd session today. Do take a little time to participate in our survey. If you have not already done it, do help us with some feedback that will help us to improve the series. We have one more, as I said, remaining in this series. The recording of today's webinar will be available on CGM's YouTube playlist within 2 days. I won't give you the link. You can find it, but you can also sign up for newsletters when you visit the CGM website. And once again, just a little plug for the fourth event in this series, Carbon Webinar Session 4, Carbon Pricing in the Malaysian Context, 7th August at same time, 6 p.m. And do attend our inaugural National Climate Governance Summit 2023 from the 5th to the 7th of September. It's going to be online and as well as a hybrid, online as well as at Sasana Kijang, and you can register at the CGM website, www.cgmalaysia.com. With that, it's been a wonderful time speaking with you gentlemen and taking questions from you, the audience. Thank you very much. Have a very pleasant evening. Thank you.